Hi there, this is Konstantin here with K5 Mortgage, and in this quick video I would like to explain and show you some numbers for the average kind of Canadian using the Smith Manouever calculator here. So I just put for the average Canadian whose household income is $100,000, just put $100,000 in terms of income, and I didn't put any investment income, any pension income, any rental income whatsoever. And based on these inputs, income is 100 grand. So for the assets, I can only put stocks. You might have $10,000 in the stocks and non-investment property assets, and might be emergency fund of $5,000. Liabilities, I don't use any liabilities for that purpose of calculation. Marginal tax rate, I will put around 35% here. And then your mortgage information. So if you take the average home is 500,000 and the mortgage balance is 400,000 to get this strategy work, and interest rate I will just put conservative 3%. As of today, rates are lower, just a little bit over 2%, but I use conservative numbers. Amortization will be 25%. Your monthly payment is $18.93. The advanceable line of credit is going to be prime 2.45 as of right now, and I use prime plus 1, which is very conservative. Usually we can take somewhere between prime plus half, prime plus 1, 0.5 or 1%. And that's where it gets started. So as you know, the Smith Maneuver, if you read this book, you understand it. If you don't, please reach out to us and we can ship a book to you, because I cannot explain this in a 5-minute video here. So if you use investment portfolio at 8% growth rate, when you pay $1,800 every month using the Manulife product that we are big fans of, and you can actually watch another video to explain how Manulife works, you be able to get $700 back the next day you paid your mortgage principal and interest. So if you use this money and conservatively invest into stocks, mutual funds, real estate, your own business, or lend money out at a very conservative rate of 8%, then the next day you'll be able to borrow $731 to invest. And that's how you see the numbers on the right is changing here. So basically, without new money, you're just kind of paying your mortgage anyways. $1,800 every month goes in. With a proper structure and a proper mortgage product, you'll be able to borrow this money again and reinvest for your future. So you will pay off your mortgage faster, your bad debt, which is your mortgage because it's not tax deductible. You convert this bad debt into a good debt, and it will allow you to generate a high net worth over the term of your mortgage. So you're kind of paying this off, and if every year you're paying interest, you deduct the interest, like this $700 that you're borrowing to invest for the future. You deduct interest on this money, and at the end of the year, you'll get a nice refund. If you apply this tax refund into your strategy here, you can shave off at least 2 years from your original amortization, which is 25 years. You can also improve your net worth for $400,000. And what I mean by that you will still have a debt at the end of the 25 years, but this debt will be a good debt. So what this means is you will generate investments over the term of your mortgage, which is 25 years, and your portfolio will look like about $740,000. Even you pay off your good debt, which you don't really recommend because, good debt make you wealthy, you will be still better off $400,000. If you just use traditional model and you just kind of pay off mortgage over the 25-year period of time, you will just kind of have mortgage-free investments in a free and clear house. With this one, you will be richer by $400,000 at least. And if you use other accelerators, and you can learn more about accelerators in this book, there's debt swap accelerator, there's a cash flow diversion accelerator, cash flow dam when you have a rental properties or a business, prime the PUP, and dividend reinvestment plan. But let's use only one of these accelerators. Let's say you currently have an investment strategy or saving program that you contribute $100 every month. So instead of contributing $100 directly to your investment or your savings account, you can actually prepay your mortgage, which is bad debt, first. Then the next day you'll be able to use this $100 and reinvest for the future. By taking only $100 every month, you can increase your net worth by almost $500,000 over the term of your mortgage, right? So your portfolio will be about $835. Because it's the new money coming in, you'll be able to shave off your mortgage, from 25 years down to 21. But realistically speaking, when you start doing this, you'll get excited and you'll see how you're shaving off your mortgage fast. You'll probably be able to squeeze a little bit extra cash flow from your personal one. And I just use $50 example here. By doing this, you just kind of shave off from 25 down to 20 years. So with that being said, you'll be able to become about $544,000 richer. So this extra $50 a month will generate about $50,000 in extra profit for you. So I will not cover cash flow them here or dividend reinvestment plan or other accelerators. This is the minimum what I promise people, that you'll be able to shave off your mortgage 5, 10, maybe 15 years if you have any rental properties, and it's maybe down to 5 to 8 years where you can be able to pay off your mortgage. And also you can build up your net worth by at least $450,000. So please give us a call, give our office a call. My direct line is 587-707-5546. So we can use exactly your numbers and put this into perspective so you can actually relate to that. Thank you.